So what I think is the big sort of contrary conclusion to the shale is that the view is, because it's like what they call the fast turn oil business, is that it will actually suppress oil prices. So if oil prices rise too much, it'll come in, production will suddenly increase, and then prices will fall down again. I actually think it's almost the opposite. Because of the structure of the industry where the landowners keep pushing up prices and they know you have to buy, and there's this sort of tension, and because it's increased so much, you have a natural decline of about 500,000 barrels a year now. If they stop drilling in the States, actually drop more than that, it'd be like 600,000–700,000 barrels would drop out of US production straight away. That's quite a lot of oil, right? That just drops out and needs to be replaced. And so actually the shale industry doesn't keep oil prices suppressed. It's actually, I think, about to become something that actually keeps the prices high. If you think about how shale has transformed legacy decline, so in the old days before shale, you used to have to replace, 50, 100,000 maybe barrels of oil a year. Now you have to replace 600, right? That doesn't suppress prices, it actually raises them up. And so the biggest disconnect then in the market, and at the moment, it makes sense because there's excess production in the States, it's hard to get out. But it would suggestive to me that the spread between WTI and Brent will actually move closer over time rather than widen, which is the current assumptions. And if that's correct, it adds lots of very interesting dynamics to how markets will work going forward.